The biggest gains in a bull market come at the very beginning and then at the very end. So um, I see a lot of people, uh, you know, when a market is in the final stages of a bear market and we've got some kind of sign that the bottom is in, people are always very hesitant to pull the trigger. They want confirmation. So typically what happens is they let a huge chunk of the beginning phase of a bull market, the baby bull, so to speak, pass them by before they're actually comfortable pulling the trigger. So they miss that opportunity. In reality, every intermediate bottom should be treated as if it is the bottom because the potential is so huge coming out of a bear market bottom during that first year. And and if it turns out that the intermediate cycle low isn't the bottom, it's not the end of the world. But you've got to try at every single one of those intermediate bottoms. You've got to try because the reward is so massive when you do catch it. So let me back this chart up a little bit. All right, here's the beginning of our bull market back in 2009. The NASDAQ, which is what I'm going to focus on here, as I think, well, obviously this is where most of the gains have come is in tech, and I think the bubble when it comes will also be in tech. But during the first year, from March to actually just a little over a year, April, the NASDAQ rallied over 100%. You know that kind of massive increase in that short a time is a very rare event. Other than occasionally you might get an individual stock to do that, but an index, a stock index, very rare for something to move 100% in a year or just a little over a year. That's why it's very important to try to pick these bear market bottoms. I mean, this didn't turn out to be the final bear market bottom, but you have to try because this is what happens when you do catch that bear market bottom. Now, by the same token, the very end of a bull market is also where you get the biggest gains in the quickest amount of time. So you've got to try on any opportunity that looks like it could be the start of the final parabolic bubble phase. You got to give it the benefit of the doubt, and you got to trade it like you think that it is that final parabolic melt-up phase. So I think this is, all the signs are here, in my opinion anyway, that this is the beginning of the final melt-up phase. So I'm gonna trade this like I think it is the final melt-up phase. And if it turns out that it's not, that we still got some more time to go, then so be it. But I am not gonna willfully miss this opportunity because I'm worried that maybe it isn't. I've got to assume, in order to catch it, I've got to assume that anything that looks like a final melt-up phase is going to be the final melt-up phase, and I want to take advantage of it. So let me show you the 2000 top. I think it's a pretty good template for what a bubble looks like, and I think maybe what we can expect here. So let me back this up a bit. All right, so this is the NASDAQ in 2000, 99 and 2000. You can see we had, this was our slingshot move down, the 4-year cycle low in 98. This set the stage for the bubble to form. The Fed cut rates down to, I think, 1%, somewhere in here. And that's what powers a bubble is central banks hold interest rates too low for too long. So I think we can check off that box. They've had interest rates too low for this entire bull market. And also, unlike any other time in history, central banks are just printing trillions and trillions of currency units. So the conditions are there to create a bubble, and maybe I would argue that the conditions are there to create the largest bubble the world has ever seen. So this is what happened during the prior bubble, and without even the extreme fundamentals to drive it that we have today. But you can see this last little intermediate cycle low right here in the end of October in 99. And then this is where we took off. We had kind of a gap up here. It kind of gapped above this resistance line. And then the market just went almost straight up. And then we had some really severe volatility almost halfway to the final top. This was, these were, I think, between 11 and maybe 14%, if I'm not mistaken. And they occurred in very quickly in just a few days. So in real time, this looked like the end of the bull market. This looked like a double top. But with the benefit of hindsight, we know that they weren't. This was just a severe volatility event on the way to that final top. We get our final top, we get the initial sell-off, and then we get a retest. I suspect the same thing will happen here. We'll get some kind of retest when the bubble does pop. And then, of course, we had the crash and the long move down. The further the bubble goes, the deeper the crash is. And from this bottom here to this top was almost 100%, and it occurred very quickly in about 6 months. So now let's go back to our present day. As most of you know, for years and years, I was saying 10,000 is going to be a piece of cake, and that 20,000 is not out of the question. Well, 10,000, we left that behind a long time ago. We're now, we tagged 16,000 this past week, and it's looking very much like we are going to hit that 20,000 during the bubble phase. And if we assume that this is the kickoff point, similar to what happened back in 99, and we have a similar 100% move in 5 to 6 months, then this could not only get to 20,000, but it might get to 28,000. And like I said, the fundamentals have never been stronger to drive a bubble, probably in history. So, even 30,000 isn't out of the question. And here's the mentality. First off, one of the mentality that traders have is they're worried that price is going to top and come back down. So they think the bubble's going to top soon. And the lesson from history is that bubbles go much, much further than anyone first expects. So when the NASDAQ bubble kicked off from 2,500, I guarantee you there was no one that would have predicted that it was going to go above 5,000 in 6 months. So the same thing here. Nobody has any expectation that this, I would say almost nobody had any expectation other than me and maybe a few other people that we could get to 20,000 or even 16,000. But we've rallied extremely aggressively out of this intermediate cycle low, and we're already at 16,000. So that's the first thing is people try to pick a top too soon, and even if they do recognize that we're in a bubble, their imagination is not big enough to contemplate the real numbers that are possible in a bubble. So they try to pick a top way too soon. So we're still very early in an intermediate cycle. So I don't think we're even close to even this intermediate cycle topping and then getting our next extreme volatility event. We could have some volatility into a daily cycle low here, but it should be pretty brief. 5 to 8 days is usually about all those last. The next longer, more significant correction is probably not going to be due till spring, or at least after the new year. So that's a big problem. Is even if traders do recognize that we're in a bubble, they grossly underestimate how far the bubble is going to go, and they try and pick a top way too soon. So that's what I'm seeing happen right now. People are they're coming around to the idea that we're probably in a bubble, but they're trying to pick the top of the bubble already and we aren't even close. At that top in 2000, the Nasdaq was stretched about 60% above the 200-day moving average. On Friday, this was only about 12% above the 200-day moving average. So not really, nothing that I would consider worthy of being called a parabolic top. At the top, your neighbors should be bragging to you about how much money they're making in the stock market. People that have no idea what they're doing will be day trading the stock market. So this kind of behavior is probably just in the very infant stages of beginning. And as we saw in 99 and 2000, it takes a few months for this to reach a crescendo, and then the last buyer buys and you get the top. So we're only like a month into this. I would have to think that it's going to take at least 5 to 6 months to get every Tom, Dick, and Harry on board and trading this market with the expectation that they're going to get rich. And then once we get our last buyer, then that's where the top occurs. So we're in the early stages. I think a lot of maybe half of traders now are starting to believe that this is the bubble, but I think way too many of them are trying to pick a top way too early. So what this is going to do is going to create a lot of chasers, people that are going to get out too early, and then the market's going to keep going up, and then at some point it becomes too painful to keep sitting on the sidelines, so they jump back in, and they're nervous, and they make a little money, and then they jump out and try and pick a top again, and then the same thing happens. Then the market runs away from them again, and then we'll get that volatility event, and that will convince a lot of people that the market is topped, and they'll sell. They'll probably sell at the bottom of that volatility event, and then we'll recover and we'll start up again, and they'll sit on the sidelines until they can't take it anymore. And then what happens is everybody will finally pile in, and they'll do it right at the or very close to the top, and then they get caught in the initial crash. But at this point, they've become conditioned to expect that any correction is going to get recovered. So they'll hold through the initial crash, and then we'll probably get that double top where the buyers will come in and they'll push it back up, but they won't be able to push it to new highs. And that is your last opportunity to get out of the way before the long grind down into that final bear market bottom, which can take years, will begin. And most everyone will miss that opportunity to get off of the bubble and get on the sidelines, and more importantly, find another asset that's going to be going up while the stock market bubble is deflating. And then real quickly, we can see that this is where as the liquidity starts to come out of the stock market, when the stock market bubble pops, it's going to look for undervalued areas to go into, and that area is going to be commodities. You can see commodities have been in a bear market since 2008. That has changed. We've now started a secular bull market. So what's going to happen is, as people start losing money in stocks, they're going to look for something that's still going up, and that will be commodities. Commodities are going to be, and they are and will continue to be, severely undervalued compared to stocks. So the money that will leak out of the liquidity leaking out of the stock market in paper assets will be landing in the commodity markets. And this is the beginning of a secular bull market that I think is going to last anywhere from 7 to 10 years. So this is where you're going to want to put your money once that stock market bubble pops. But you don't want to miss the final bubble phase of the stock market. As I said, the biggest and quickest gains occur at the very beginning and very end of a bull market, and all the signs are there right now that stocks are starting a bubble. You've got to trade it under the assumption that it is, and if it turns out it's not, then so be it. But nobody is going to ring a bell for you and tell you that it started. So anytime something that gives the impression that the parabolic move is beginning, you've got to give it the benefit of the doubt and go for it. Right now, I think you got to give the stock market the benefit of the doubt that the parabolic stage is starting.